let's move on to the third session, which is a presentation given by Dominic Rose about M&A insurance. Dominic is a senior transaction liability insurance broker and ex-M&A lawyer, both in private practice and in-house, specializing in designing and placing insurance products, e.g. warranty and indemnity, legal contingency, litigation buyouts to support Aon clients typically involved in M&A transactions. Now over to you, Dominic.
Thank you, Jessica, and hello, everyone. And hopefully, yes, you can see the my presentation now. I'll just give it a moment to appear. Yeah, that's great. Okay, thank you. So thank you for the kind introduction. That's much appreciated, and thanks also to everyone for giving me the opportunity to speak today. That's sort of enough about me. Perhaps we could move on to the second slide. Thank you. Great. So just a sort of an overview thought here. Insurance is traditionally seen as a de-risking device, something clients have to spend to achieve security and peace of mind, but that they don't particularly want to spend, since it's money out of the door, with the financial upside only realized in the event of a future claim. It's fair to say that M&A insurance certainly retains this de-risking facet, but it has proven to be a lot more creative in both its use and also the solutions it provides from as Jessica mentioned before, a process, strategic and capital efficiency perspective. And we'll come back in more detail certainly on that third point. If we can move on to the next slide, and indeed one more. Great, thank you. So M&A insurance, what do we mean by that? It's an umbrella term covering a number of different solutions that continues to evolve and respond to situations and client needs. Today, I'll primarily be focusing on one of these, and that's W&I insurance, which is the most popular and commonly used of such insurance solutions. This covers the so-called unknown unknowns, and I'll come back to what I mean by that term in a few moments. But it's worth flagging that there are other products covering certain known issues as well. The most common of these is tax insurance, but there are also other forms of contingent risk insurance, such as litigation buyout, and indeed other forms of credit insurance solution as well, which is too large a topic to be going into any great detail in today's session. If we have time, I might briefly come back to the question of tax insurance at the end of this presentation. But I just thought it was worth flagging through this graphic here that there's a raft of different risks that can be addressed through M&A insurance. But as I said, we'll be focusing on W&I insurance and the unknown risks, so the left-hand side of that graphic. So now let's go into a slightly deeper dive into W&I insurance. If we can move on to slide 6, please. Great, thanks. And therefore the highlighting there just clarifies exactly what we're talking about here. In a nutshell, W&I insurance protects the insured against the financial loss resulting from unknown breaches of the statements of fact as to the target's affairs, i.e. the warranties and the tax indemnity, the so-called W&I in W&I insurance, given by the seller or sometimes other parties related to the seller in the SPA, i.e. the sale and purchase agreement. Move on to the next slide, please. Thank you. I've already mentioned that it is way more than just a de-risking device. Having said that, there's a considerable number of additional value, process and strategic benefits to using W&I insurance. This slide gives quite a lot of detail as to all the different considerations that might be at play driving the client's decision to use the product. But just to summarize and identify a couple of examples, it allows negotiations between the seller and the buyer to progress more quickly and more efficiently, effectively taking issues off the negotiating table, such as the level of protection that the seller is willing to offer, or the duration of the survival period, how long it's willing to stay on the hook for that protection, and thereby facilitate the closing of deals. It also allows the buyer to choose the level of protection it wants. Conversely, it allows the seller to reduce its outstanding liability post completion of the deal, increasingly often these days, to only a nominal amount, thus allowing the seller to achieve a completely clean exit from the sale. And we'll come back to this hugely important capital efficiency consideration shortly. A few other important examples. Very importantly, W&I insurance can also be a useful device to ensure, for instance, the buyer maintains a continuity of relationship with ongoing management who gave the warranties in the first place. And what I mean by that is that if for instance, a significant part of the value of the asset is placed by the buyer in the management who have run that asset historically, and it therefore wants to ensure that that management stays with the target post completion of the deal when it itself now owns the target. That management, those key management individuals will probably have been the individuals that gave the warranties in the first place when they were on the sell side. And if the buyer subsequently post close of the deal discovers a breach of warranty and wishes to make a claim, it probably doesn't want to sour its relationship with that ongoing management by having to make a claim against them and thereby jeopardize that ongoing relationship. So that would be a very clear reason why you would instead seek to make a claim against a third-party insurer and thereby preserve the relationship with the management that gave the warranties. Or sort of similar to that consideration, if the seller and the buyer of the asset remain important commercial trading partners post-close of the deal, that would be another reason why the buyer probably wouldn't want to jeopardize that relationship by making a claim against the seller. Again, a good reason to claim instead against a third-party W&I insurer. Alternatively, the buyer may have concerns regarding the seller's future solvency or its ability to recover from the seller post-close of the deal. For instance, if the seller is a fund that is intending to wind itself up post-close of the deal once it's disposed of the asset in question, or where, for instance, there are multiple sellers, perhaps individuals that have been with the business for a long time. They may be located in numerous jurisdictions around the world. In those circumstances, the buyer having to contemplate making a claim against them for a subsequently discovered breach of warranty or claim under tax indemnity is potentially very time-consuming and prohibitively expensive. Again, far easier and cheaper just to make a claim against one or a small number of well-capitalized insurers, most typically, not always, but most typically based in London. It just makes the whole process for claiming much simpler and cheaper. And also, very importantly, there can also be strategic value to using W&I insurance in auction processes. Sellers are increasingly baking the use of W&I insurance into their auctions, initiating that W&I process with the expectation that the successful bidder will ultimately buy this policy, thus leveling the bidder playing field and ensuring an enhanced comparability between bids. So, for instance, and we'll come to this in a little more detail very shortly, but generally speaking, it is the buyer who is ultimately the purchaser of the W&I insurance policy, the insured under that policy. But very, very commonly these days, the sellers will effectively kick off that process, effectively draft a suite of warranties that they are prepared to give to the successful bidder in the auction, but cap their liability in relation to those warranties, often to as little as a pound or a dollar, thereby ensuring they have a clean exit post-close of the deal. And they will gauge the conceptual appetite in the insurance market to cover those warranties and tax indemnity, present their findings from that exercise as part of the auction process to bidders, and basically say, these are the warranties we're prepared to give, and we will disclose against them in the ordinary course, but don't, and you can take this suite of warranties, you, the bidders, can take this suite of warranties and go and get them insured and achieve the level of protection you want, but don't think you're coming back to me for that claim. It's up to you to purchase the protection you want directly from the insurer. We move on to the next slide, please. Thank you. So here, I mean, this is just an illustrative example, you know, and the sort of, you know, illustrative figures punched in, but I mean, obviously it varies from transaction to transaction. But what we're trying to show here is just the application of this capital efficiency consideration and the great benefit from this perspective provided by W&I Insurance. So I mentioned a little while ago that the W&I Insurance isn't like most lines of insurance, where the so-called financial benefit of the policy is only seen in the event of a subsequent claim. Rather, W&I Insurance realizes a day one value benefit because it addresses the inefficient deployment of capital concern of holdbacks and escrows, and we'll come on to what those are in a little more detail shortly, or indeed simply tying up the seller's capital efficiency, which is a very powerful tool for company boards and indeed their M&A teams. So just quickly to look at these figures, if for instance you had an asset being sold / bought for $100 million, and you assume a cost of capital of 20%, and obviously that's going to vary depending on the profile of the client, whether they're private equity, corporate, etc. But it's just by way of an illustration. Assume a cost of capital of 20%. Now, in the absence of the use of W&I Insurance, what you might commonly see is that the seller and the buyer negotiate the warranties. The seller agrees to retain for a year or more a level of liability in relation to those warranties it's given. Let's say at 10% of the enterprise value, so you know, $10 million. Because the seller and the buyer, you know, if I say don't trust each other, you know, they want to ensure that money, neither of them retains absolute control over where the money allocated to service that theoretical liability sits for the duration of that retained liability. They might agree to put that money in a third-party escrow account. So a bank account where an escrow agent would look after that money and determine where it goes, either to the seller if once the survival period has ended, if there have been no liabilities identified, then the seller would get it. But if a liability for a breach of warranty or claim under tax indemnity were identified, then the buyer could make a claim under that escrow, from that escrow account in order to make good the loss it has suffered. So, you know, that there is obviously a fee that the escrow agent would charge for that. Here we've assumed one of 0.5%. And so the cost of the escrow, you know, assuming the figures we're talking about here, would be $50,000. And for the duration of the time that the money is tied up in that escrow account, it's obviously not, you know, the seller is not able to do what it wants with that element of the proceeds of sale. It can't reinvest that money. It can't distribute it back to its shareholders or whatever it wants. So that cost of capital, you know, it is reflected in the opportunity cost capital of $2 million. If you look instead at the use of W&I Insurance to eliminate the requirement for that escrow account, then effectively you've avoided the $50,000 of the escrow bank account payment. You have avoided the opportunity cost of capital. You've obviously had to pay a premium to the insurer for taking out the W&I insurance policy, and here, rather conservatively, we've put that as $150,000. That's, depending on a number of factors we can go into in a minute, potentially quite expensive, but so in fact the figures could look even better. But if you factor all that in, then you can see that we have realized a day one value add of $1.9 million. Therefore, you know, as a percentage of the purchase price, with these figures, that's 1.9% of value created through the use of W&I insurance to dispense with the alternative structures of a holdback or an escrow. Okay, if we can move on to the next slide. Oh, sorry, and one final point I should just add there, that all these figures are not even factoring in the eventuality of a subsequent claim. Obviously, if there were identified to be a subsequent claim and the insurance policy pays out as a result, then obviously the economics look even better. Can we move on to the next slide, please? And so I won't linger too long on this slide, but basically, you know, that bottom line as a result of what I've just been discussing is that W&I insurance has been a very successful product over the last 7 to 8 years in particular. There's been an exponential rise in the uptake of it since the GFC 2008-2009. And it is now increasingly, and in fact, I think it can just be stated to be a standard feature of private M&A these days. So not every deal will use W&I insurance, but it is in an increasing proportion year on year. And indeed, a lot of private equity houses, for instance, are required at least to consider the use of W&I insurance when they are entering into M&A. And corporates are very much catching up also with their use of the product, often finding in their experiences in auction, if they have historically lost out on an auction because they have not offered the use of W&I insurance and seen that the successful bid has come from a private equity house that has used it, they have learned from that and are increasingly recognizing the value of W&I insurance. If you look at the graph on the top left here of this screen, obviously, you know, as a result of the sort of the COVID environment of last year, M&A activity as a whole was substantially down, and that sort of accounts for why sort of the use and these are the policies placed by the Aon team in Europe last year was smaller, but we certainly had a very our figures did very well in comparison with levels of M&A activity last year and this year, where levels of activity are sky high. There's been a phenomenal number of policies and activity we've engaged in for the first half of this year, and we see no signs of that slowing down at the moment. So there'll definitely be a substantial uptick in those figures when we look at them at the end of this year. So we can move on to the next slide, please. So I just thought it was worth doing a slightly deeper dive into the product itself and how it works. So first question, what are warranties and indemnities for those who may not be so familiar with this terminology? They're essentially the contractual promises given by the seller in the SPA to the buyer. So warranties are statements as to the state of affairs of the business being sold, so be it in relation to accounts, tax, material contracts, litigation, employees, IP, IT, insurance, etc., etc. If these are subsequently shown to be inaccurate, the statements that is, then the buyer can make a claim for the loss sustained. Indemnities, on the other hand, are contractual promises to pay upon the occurrence of a specific event. And when we're talking about indemnities within the context of a W&I insurance policy, we're talking specifically about the tax indemnity as opposed to other bespoke deal-specific indemnities. The purpose of these warranties is twofold. First off, it's an allocation of liabilities between the seller and the buyer. And secondly, it's a disclosure purpose. So when giving the warranties, there'll be provisions in the SPA allowing the seller to make disclosures, against these warranties in relation to matters that would otherwise constitute breaches for which the buyer could make a claim. In making such disclosures, the seller avoids liability arising from such issues, whilst the buyer has been given a clearer picture of the assets it is buying. Before W&I insurance came on the scene more than 20 years ago, the allocation of liability between the seller and the buyer for breaches of these warranties or claims under the tax indemnity, as I've described, was typically addressed through the buyer holding back an agreed proportion of the sale proceeds for a period post-completion of the deal, and/or escrows, where that money would be kept in a third-party bank account. And this compromise often resulted in neither party, either the seller or the buyer, getting everything it wanted from the deal. The buyer perhaps not getting as much protection as it wanted or for as long as it wanted, whilst the seller would find, as I mentioned before, a significant proportion of its sale proceeds tied up for a considerable length of time after completing the disposal in order to service its theoretical liability for a claim that might never arise. And if this involved an escrow, they would also have to pay a third-party fees to administer this money in a bank account, paying little in the way of interest. And even if no specific holdback or escrow had been agreed, this liability could be tying up the seller's balance sheet in a suboptimal way. So this is where W&I insurance has stepped in to bridge that gap between the sellers and buyers' requirements. Can we move on to the next slide, please? So I want to make a differentiation here between sell-side and buy-side policies. So first off, we're talking here about sell-side W&I. So W&I insurance has existed in some shape or form for some 25 years or so. The first deal I was ever involved in private practice as a very junior lawyer, where it was used, I think, was in 2001. It was a very different animal then from what it is now. And as you'll see in the top left of this slide, I identified the fact that we do still place sell-side policies, but they are a small minority. There's somewhere in the region of 5% of all the policies we place these days. And with a sell-side policy, again, like the traditional negotiations between the buyer and the seller that I showed on the previous slide, here you would still have the seller and the buyer negotiating the warranties and indemnities between them relating to the target. And post-close of the deal, if the buyer identifies an issue that constitutes a breach of those warranties, it would make a claim against the seller as a result. And the seller, if it had taken out a sell-side W&I insurance policy, would then make a claim against the insurer in respect of the liability it has sustained to the buyer. With the exception of if the seller knew about the item or if there's some fraud involved. So a key point to note here, the seller has to retain the liability to the buyer in order to retain an insurable interest, which it can insure in the W&I insurance policy. If we can move on to the next slide, please. So contrast that with buy-side W&I insurance. And this is the overwhelming majority of the policies we place these days. So again, the seller and the buyer still negotiate the warranties and indemnities relating to the target. There's no need for an escrow account. So the seller, increasingly commonly these days, has a completely clean exit post-completion of the deal. And the buyer obtains the level of protection it requires directly from a third-party insurer. Therefore, it can make a claim directly against the insurer in the event of a subsequently discovered claim loss, and the insurer would not then make a claim against the seller to recover any payout under the policy, except if there was determined to be seller fraud. Having said that, sellers often initiate these processes, i.e. they will often, if, for instance, in the context of an auction, they will engage with a broker to go out to the market to gauge the conceptual appetites to insure the transaction amongst the W&I insurers, and then take the findings of that exercise to the buyers and effectively say, we will give you the warranties, but don't think about coming to us for a subsequently discovered breach. But don't worry, because there is appetite for insurers to provide you the protection you want. It's over to you to sort that out directly. Can we move on to the next slide, please? Thank you. So quick overview of key terms. So yeah, seller may be initiating process, but generally speaking, the buyer is the insured under the policy, would make a claim directly against the insurer. The cost of it generally is a one-off premium paid shortly after completion. We tend to express costs as in terms of the rate online. That's expressing the premium as a percentage of the policy limit sought. It's up to the buyer how much protection it wants, but it's generally somewhere in the region of 10–30% of the enterprise value. There will be exclusions from cover. There are the standard ones, and we list them on the right here. It doesn't apply to every deal, but they're worth bearing in mind. There may be some deal-specific ones, and if there are gaps in the diligence, if we're not just covering, if there are known things we don't know about, you haven't looked at an individual jurisdiction, for instance, there's likely to have an impact on the cover under the policy. Can we move on to the next slide, please? Thank you. I won't linger too long on here, but it's just important to bear in mind that the due diligence is what the insurer is primarily reliant upon when doing its underwriting and reviewing the risk. And therefore, it's very important to give proper consideration to that suite of due diligence that will ultimately be provided to the insurer for their review. And if there are gaps in it, that is likely to have an impact on the breadth of cover offered by the insurer. And it's not the intention of a W9 insurance policy to plug the gaps in the target's insurance program. Next slide, please. Just a quick word, thank you, on the process. So it's generally a two-stage process. First stage is going out to the insurance market, obtaining what we call NBIs, non-binding indications of interest, basically their heads of terms of their proposal for the insurance. Once you've then appointed an insurer, you go into stage two. That's the underwriting, where you provide the insurers with the DD reports, the due diligence reports, access to the VDR. They review all the information, you negotiate the policy. Generally takes the process somewhere in the region of 2 to 3 weeks. May take a little longer if everyone's very busy or if the underlying deal is taking longer, but that's generally the kind of timeline we're talking about here. If we can move on to the next slide, please. Yeah, just very quickly. So this just shows the how the timeline may vary depending on if the seller has initiated the process. There are different ways in which it can tee up that process. How much of the process the seller does before it says to the buyer, over to you. Where I talk about soft flips, where the seller basically just runs the NBI exercise, and then it's up to the buyer to appoint the insurer and do the underwrite. Or sometimes a seller will go further than that on the sell side and actually not just do the NBI exercise, but appoint an insurer, do as much of the underwriting as they can before then ultimately flipping to the buyer to complete it. That's what we call a hard flip. Next slide, please. And the following slide. Great, thank you. So I just touched very briefly on this point. I mentioned at the top of the presentation that there are various different M&A insurance products. We focus primarily today on W9 insurance, covering the unknown unknowns, the matters that come to light post-close despite the due diligence and disclosure processes undertaken. But there are other products, for instance, tax insurance, contingent liability, litigation buyout insurance, addressing known risks. The sweet spot for these is items that are ultimately concluded to be low risk, but potentially have a very high quantum, but are amenable to legal review, ultimately concluding, as I said, that the specified item is low risk. It can be very attractive to pay a one-off premium to transfer the risk in relation to such point from the parties to the transaction to a third-party insurer. And it's also worth noting here that these policies are not always even connected to a live M&A transaction, but could be put in place, for example, when a private equity client is looking to wind up a fund. I think I've exhausted my half an hour, so I think we'll wind up there, but I'm happy to take any questions at the end of the session, if anyone indeed has any. I hope you found this informative and enjoyable, and I just want to say thanks again for giving me this opportunity today. Thank you.
Great. Thank you, Dominic, for sharing your experience on M&A insurance with our audience today. I believe our audience learned more about risk transfer solutions, especially the warranty and the indemnity insurance. And there are some questions from the audience, but we will cover those in the Q&A session. Thank you, Dominic.